An intelligent investor beats the market, says Benjamin Graham in his book of the same name, The Intelligent Investor. Beating the market means defeating the rate of inflation and, more than that, the market benchmarks like SENSEX and Nifty. So are you an intelligent investor? Do you want to become one and beat the market? This is the video where we take a simplified look at Benjamin Graham's The Intelligent Investor to reveal some virtues and truth bombs from a 640-odd pages book from the mid-20th century. If you do not know who Ben Graham is, he's the founder of value investing philosophy and the guru of Warren Buffett. Mr. Buffett described it as by far the best book ever written on investing. So, with some deep digging, we've brought you lessons from the book that threw open value investing from stocks to the public. Do you want to become a real intelligent investor? Then let's go. So hit the like and subscribe buttons and let's deep dive into the lessons of the book. Chapter 1. Investing in Stocks. We'll have to learn some basics about wealth first. An intelligent investor has only one goal, accumulating wealth, and the book shows ways of doing that. So, a recap on how wealth comes to a person. First, they're born into it. The Tatas and the Birlas are called ours because wealth runs in the family through generations. The second is entrepreneurship. You invent, innovate, and capitalize on the idea. Steve Jobs built Apple as a personal computer company to solve the computing requirements of people at lower cost and accessibility. Building further innovations on scale gave it the status of the world's first trillion-dollar-plus valuation today. Third, what we're looking for is investing. Become a partner in such wealthy or entrepreneurial ventures and get rich passively. So, the easiest way to become rich if you do not possess intellectual or genealogical advantages is to invest. But you must think about where and how to invest. So the best answer from above is to register a partnership with people with the other two advantages. This is nothing special. You just need to buy its share or stock from an exchange. Stocks are the fundamental form of partnership whose deed or agreement is very liquid, meaning you can transfer it easily. The mantra from the book given by Graham is, price is what you pay, value is what you get. You must pay the least and buy the best, then wait for it to turn into tremendous profits. Take the case of Berkshire Hathaway, the investment vehicle of his disciple, Mr. Buffett. Its stock has risen from $730 in 1982 to $456,800 currently in 2022, a whopping 62,475% or 624x rise. This is what you need to buy value. To be an intelligent investor and find compounders that compound money through years and years. Let's learn more about how to do that. But before that, if you're liking this video so far, drop a like and press the subscribe button for more such content. Chapter 2. Investor versus Speculator. We already know what intelligent investment is, but to know more about how to become an intelligent investor, we first need to define some characteristic traits of such people. According to Graham, the intelligent investor is disciplined, patient, and eager to learn. More than possessing any special intelligence or high IQ, what he needs is high EQ or emotional quotient. The intelligent investor can think rationally and act objectively. In fact, he needs to have the emotional capacity and discipline to act against the crowd in a contrarian manner. Let's look at why and how. We all know markets are volatile. Stocks running 52-week highs a week ago can tank to 52-week bottoms today. This edgy and impulsive behavior of the market has been personified by Graham as Mr. Market in this book. Mr. Market is simply the average of all investors in the market. He's very fickle-minded and is easily influenced by what his neighbors or stockbrokers say. He'll go out and buy more stock when he reads the news of some fad turning rags to riches only to see it tank a few days later. In short, Mr. Market is someone who buys high and sells low, while going with the flow and acting with the crowd. For Graham, this is a quick and sure way to go bankrupt. So if you're like Mr. Market, who believes everything they hear on finance TV channels or from broker recommendation and act for a quick buck, then you are a speculator. A speculator is a person who does not know or care about the underlying fundamentals of the investment. He just wants to make money. He'll see a price chart and if it is going up, expects it to continue. Then when it doesn't, he loses money. On the other hand, the intelligent investor is someone with EQ. He can think for himself. For Graham and other value investors, the market volatility provides opportunities to buy brilliant quality stocks at dirt cheap prices. Therefore, the speculator's counterpart, that is, the investor, is a contrarian thinker. He sees the flow and thinks critically to see if the market is overvalued or undervalued, meaning is it priced higher than it deserves fairly or lower. Investors will hunt such undervalued stocks and wait patiently for them to return to fair value. This is the difference between an investor and a speculator, a key lesson of the book. So, which one of these are you? An investor or a speculator? Go down into the comments below and give your answer. Chapter 3. Investing Strategies in the book. Now that we know what an investor is, let's jot down strategies of investment given in the book that can make you rich slowly but surely. So, basic characteristics of a good investment are: it is undervalued, has good future potential, has low debt, and has good management to take care of the fundamentals of the business. The book has given a deeper methodology of how this can be analyzed with numbers given in the annual reports of the companies. Let's keep it simple and call what the book terms security analysis. You won't lend money to a friend who does not return it, right? In the same way, you should not invest in anything which you can't trust with money. This is the foundational strategy for becoming an intelligent investor. Graham has further given two broad investment strategies based on the type of investor. The first one is the defensive investor. This is someone who does not like risk and volatility and likes peace of mind. Thus, he's more of a passive investor. As per the book, such an investor should allocate 50-50 of his resources to high-grade bonds and stocks. This will give him protection and regular returns from bonds while a chance of hitting the bullseye on some compounder stocks. A retired senior citizen is more likely this type of investor. The other one is an enterprising investor, who is an active investor. Someone who has a higher risk appetite, can give time to analyze stocks in deep, and is targeting a higher rate of return. They have the flexibility to invest in bonds at all. They are after high returns and so can do whatever suits them. However, even enterprising investors have to act with the virtues of an investor discussed above. They have to chase value and not speculative fads. They must conduct security or fundamental analysis of the business and keep a margin of safety to survive the adverse environment. A young lad like yourself or investment managers like Buffett fall under this category. For each type of investment strategy, Graham prescribes very meticulous checklists for security analysis that includes factors like a position in the sector, low debt, earning stability, and price-to-earnings ratio. This helps evaluate the fair value, and hence the price you pay has to be significantly below that. Chapter 4. What should you do? First things first, you have to become an investor and leave your habits of speculation. Trading and investing in fads without any fundamentals like cryptocurrencies have to be avoided. One of the things to remember from the book is to keep a margin of safety. Similar to how you leave early to catch a flight, you should keep some buffer for errors in investments as well. According to Graham, intrinsic value is equal to earnings per share multiplied by 8.5 added to twice the expected annual growth rate. But you must not invest at a price that is not significantly far from the intrinsic value. For example, the average growth rate for HDFC Bank is around 18%. By this formula, its intrinsic value will be about 2970 rupees at an EPS of 66.8 rupees for 2022. The current price is 1630, which indicates a 45% undervalued nature. So an investor is safe buying such investment trading way below its fair price. Graham has also used this example to explain that risk and reward are not correlated as seen in most news media. Just beta or volatility is not a good measure of risk. Risk lies in business fundamentals, not price. Here, for HDFC Bank, ask yourself which is riskier: to invest at 3,000 rupees because it is going up, or at 1,000 rupees because it just stumped down. As per this book, it is the second one as its fair value is much higher. This actually happened in 2020 after COVID. From that sudden fall below 1,000 rupees, it has given over 65% returns as nothing was wrong with the business. We do not advocate purchasing bonds for most small young investors who neither have the capital nor the inclination. We think the book makes it clear that you must analyze your own risk appetite and decide whether you're a defensive or an enterprising investor. Either way, you have to compute security analysis for a potential investment. Defensive investors may go for a greater allocation to large-cap blue-chip stocks, while the latter ones can take greater bets in more volatile, small and mid-cap stocks. To reiterate, either of the investments will not go through without a thorough quality check. Graham has said that there cannot be any higher obligation from a lower company, meaning a low-quality stock cannot deliver on its high promises of growth with certainty. The bottom line is, you have to become an investor and think contrary to the market to actually buy low and sell high. This still requires fundamental analysis of stocks to check the quality and earnings potential. These two things help you to get more value than you pay for, which increases the certainty of returns and reduces downside risks. Lastly, Graham says in the book that an investor is forever an optimist. So be optimistic and stay emotionally intelligent as an investor, and follow the guidance of the intelligent investor to maximize your returns. Happy investing! Don't forget to type down in the comment section which type of investor you are, a defensive or an enterprising investor. Press the like button if you haven't already and subscribe to the channel for more such content. Do you want to know more about how money works and want to maximize your investment returns? Then visit this video to see the Psychology of Money book summary.